So I've been selling real estate for 21 years, and real estate never really went down at all, except for a small little blip here and there. But essentially, it just always rose back up because of the way just how cheap money exists. Problem is that doesn't exist anymore, and we're in a real crisis right now with prices falling. Those of you guys that have bought pre-construction are underwater, and you're about to close. What do? You're freaking out, right? So stay tuned to this video. I'll talk to you about some solutions that maybe might get a little creative.
Look, I get it. The Toronto real estate market is confusing. Whether you're a new or experienced investor or just looking for a home to raise your family in, join us at Broadview Table Talks as we sit around the table with my friends to talk about the real estate and the ever-changing market in Toronto.
Okay, just to start, this is just a disclaimer. I'm not a lawyer. Talk to your lawyer or legal professional if you have a specific situation that you need help with. That's not me. But what I can tell you over the past 21 years and my experience of buying and selling myself, lots of pre-construction condos, like a lot, and also helping other clients buy even more pre-construction condos, I've been in the game for a long time. The reason why it was the right thing to do back then, I always recommended it, is because of cheap money. Inflation was rising faster than what the interest rates were. So if things were going at prices, asset prices, real estate prices were going up at 10% a year, which they were for many years, rates were like, 2%? That spread of 8% you'd get to keep in your pocket just by holding real estate. Like, that's a no-brainer. You'd be stupid just to let your money whittle away, lose negative 10% a year because of inflation. I always recommended buying real assets, but now I'm learning that, guess what? Rates can go up. And they have gone up since 2022. Those of you guys that are in the last remaining train, I guess, of the real estate, and you have closings coming up for pre-constructions in either end of this year or next year, and you're freaking out because the asset values have gone down so much and the appraisal values won't meet. Well, I'm going to go through some solutions. There's three main solutions. It's basically something to do with money, so financing based. The second thing is to do with your contract itself. And the third thing is just like, oh, shit, like Hail Mary, get me out of this contract. Let's see what we can do, last resort. And each of these situations have about 5 or so different solutions. So I'm just gonna get a little creative with you. Hopefully you can start thinking outside the box, because ultimately you are on the hook for this contract. When you signed it, you're committed to it. It's a legally binding document. In Canada, there's non-recourse. I mean, it's all recourse. Unlike the States or maybe some commercial mortgages, recourse meaning that you're on the hook to pay the difference. Don't think there's some sort of like way you can get out of this and some magic because they wrote the APS wrong. Like, don't think of that. Just think about how you can resolve the situation if there's still time for you. And then there's those of you that think that it's not fair that developers can back out of a contract if it's just not profitable for them. The case in point is the one, Mizrahi's One Bloor East, or One Bloor West, I should say, and now Tridel taking over. Apparently there's some recent court filing saying that they want to cancel all the contracts and turn it to a hotel brand, super high end, and make more money because they need to make more money because they're underwater. Well, guess what? You're signing the developer's contract. They're not signing your contract. It's something you agree to, and the paperwork is, of course, can be stacked towards them when you signed it. So it's just what it is. If you don't like it, just go build your own condo at the end of the day. Not to be crass about that, but it is what it is. Like, you're in the situation, just face it. No one's going to come save you at the end of the day. If we look at financing solutions, the most obvious one is to go through RBC to get your blanket appraisal. It's commonly known in this industry that RBC is offering blanket appraisals. They're basically turning a blind eye to the actual worth of what the asset value is. I don't know how they're getting around OSFI regulations, but it is what it is. Everyone knows that this is a crisis. I'm sure they know that as well too. The Office of Superintendent of Financial Institutions, they regulate the banks and they set the rules to make sure that the lending practices are safe. And this is why Canada has been known to have such great lending practices. And we missed the financial downturn in 2008 in the US with the housing crisis over there. The reason why they do this is because I think they know that if the individual purchasers go underwater, then that's not as bad as the developer going underwater, because the bank's money is actually into it. They lent for the construction, and oftentimes this could be like $200, $300, $400, $500 million, which is a big chunk of money to have disappear. They're taking their chances and rolling their dice, and I think this is just the best way. Let's just say, for an example, you bought an $800,000 condo. Over the course of 2 years, you put your 20% down, so it's $160,000. You still have a remaining balance of $640,000. But the problem is that same condo, it's probably a one bedroom that you bought in 2021 or 2022. On the resale market, something very similar, something very comparable in the building next door, even in the same building through an assignment, you could buy that same thing for $500,000 or $550,000 or whatever it is, right? Let's just say it's $500,000, so there's a $300,000 shortfall, but you only put $160,000 down, which means you truly have to put down another $240,000 down just to make the asset equal. But then if you're also borrowing a mortgage, no lender is going to give you 100% loan to value. They're going to have to want a 20% down, or depending on what you qualify for. So that's another $100,000 down. So basically, $800,000 purchase price, $160,000 down, 20%. You're going to have to make up that shortfall again of $240,000. So that's $300,000 now, plus another $100,000 for the 20% down for an 80% mortgage on the appraised value. That's $400,000 you got to put down. Additional $260,000. How many people actually have that lying around? And I can tell you, it's not a lot of people that have that. If it's a mom and pop investor that just bought a pre-construction because that was the way to get rich, and it was back then, what do? Okay. Qualify for the blanket appraisals. It just means that RBC will just look away and they'll give you the loan based on what you bought the purchase price for. The problem is you have to have pretty high income to qualify for a $640,000 mortgage. Not very many people can do that, especially in today's economy. Commissions are down, salaries are down, people don't have jobs. Like, just the economy is just bad overall, whether it's from high interest rates just crushing the inflation on purpose, or it could be Trump's tariffs and all that. It's just, if you look around, like, nobody has money anymore. Like, not very many people do anyway. If you don't qualify for that, what else do you do? Think about it. Maybe you have other assets. Maybe this is not your primary residence. Perhaps you can refinance your house that you live in. Use that for the down payment or all of the money. If you're fortunate enough in that situation, great, right? But again, not very many people are in that boat. But you could probably do it with a partner or family member or brother, sister, cousin, whatever. Maybe they have the ability to bail you out and they can finance their place to help you out a little bit. You'd have to owe them a personal debt, and because you're family, maybe hopefully that you're good for the money. But let's say you don't have family members or friends that can help you out, or that are willing to help you out, or you're just afraid to ask them for it. Then what else can you do? Well, you could do the same thing with private mortgages or B lenders. It's like the home trusts and the equitable banks and the whole bunch of other names, credit unions maybe even. They have options where their lending criteria is a little bit looser than what the big five banks would be. Those institutions could be a little more lenient on the GDS and TDS ratios. Banks basically qualify you for gross debt service and total debt service, right? Don't call me, you can talk to your mortgage broker about this, but it's anywhere from 32 GDS and 44 TDS, I think, something like that. Anyway, basically, let's call it a third for simplicity's sake. All the expenses of your mortgage, including the mortgage insurance and principal, maintenance fees, taxes, heating, and just anything else, insurance, I think, also is included in that, has to be no more than just roughly a third of your gross annual income before taxes. Again, you may not qualify for that, so that's when you need to bring a partner in or a co-signer, or you have to refinance something else, or you have to borrow from family members or investor groups or just something. Basically, those are just financing solutions, creative financing solutions, where you're not borrowing just on that asset itself, the pre-construction condo that's gone down in value. You potentially can borrow on another asset that whether you own that, partner owns that, a family member owns that, or something else, or maybe get some sort of more looser borrowing criteria, mix it all together. I hope that makes sense. Financing-based solutions, see what other assets you have. Maybe it's Bitcoin, maybe it's gold, maybe you just have to sell expensive jewelry. I don't know, whatever it takes to basically get that money to pay off the developer so you pay what you committed to. And here's where it gets interesting. Let's talk about some contract-based solutions, things like VTPs and assignments, forgivable loans, and things like that. Just like builder renegotiating with you. The chances of this happening, first of all, is really low. The assignment market is kind of dead, especially since the resale market or the assignment market is actually worth less than the equity you still have in the place, or so-called equity. The basically the down payment that you put into the place, the values might have dropped more than that. So it means there's some situations where I've seen people actually have to pay money to get out of the contracts to somebody else. So in that situation of $800,000, you put $160,000 down. Somebody offers you $500,000 for it. That means you got to pay them $240,000 extra just to avoid liability. Like, how smart is that? Like, that's not realistic right now to buy assignments anymore. Unfortunately, I think in today's market, that boat has sailed. Another thing that I've been seeing happening is if you buy into a project that has a lot of remaining inventory, perhaps you can renegotiate something with the builder where you swap their units for something smaller. So let's say you bought a 2-bedroom, let's call it $1 million or $1.2 million or something, and they have a couple 1-bedrooms or studios remaining. So rather than you defaulting and not even be able to close on it, they still need to get their numbers. They still have to have a lot of unsold inventory, and they still need to sell units. So their best case solution is that you buy something else within that project. So maybe there's a situation with that. You got to talk to the builder or to the sales representative, and hopefully you'll get some sort of solution. Perhaps you have some sort of like discount on the rate that you paid. It's very unlikely, like I said. They have no obligation to give this to you because ultimately they can sue you for what you owe because you wrote a legally binding contract. But maybe there's a situation where, they do a land registry search on you, a title search, and they find that you don't own any properties and you have basically no money, you're about to declare bankruptcy. Well, you can't squeeze blood from a rock. So maybe they'd be willing to negotiate with you. the higher ups, the decision makers, they might be willing to maybe give you a discount. And like I said, I haven't seen this yet. It's pretty rare, so I wouldn't count on that. Something that they might actually do, though, is extend your closing a little bit. I don't think they're willing to wait for years for you to make that money up, the difference up. Not even months. I would say weeks, if anything. So maybe that doesn't help you. Maybe it does. Or maybe you negotiate a settlement with the discount rate. Again, it's the Hail Mary pass. If they give it to you, maybe they can do it where you're not actually paying them any discount. You're still on the hook for it. Maybe they might give you what's called a vendor take-back mortgage, meaning that if you owe them another $240,000, you're not going to give it to them now because you don't have it, but you pay it back over a series of, 2, 3, 4, 5 years. Now they're registered in second position behind your first position title. Again, I haven't seen this happen, especially not with the large developers, because you don't have any leverage against them. It's like David versus Goliath. Like, there's no way that they're going to allow you to do this. They'll just crush you and just move on to somebody else and sell it to somebody else. So don't bank on that either. But if you're working with a smaller developer, maybe there might be some solutions out there, and maybe they might be a little bit more flexible. I'm not saying developers are the bad guys. They're not trying to crush you. It's more so that they have other options. I'm in a group chat right now, and they somehow just kick me out. Like, forget them. Like, they think I'm the developer. I'm not the developer. I'm trying to give them honest advice. They just don't want to hear it. But ultimately, there's 25 people or so that banded together in a building of 550 units or so, which is going to do nothing for the developer, especially since this developer is well capitalized. But say it wasn't a well capitalized developer. If those 25 people band together and say, I'm not going to close, and they kind of go on strike against the developer, and the developer doesn't want to sue them because they don't want any money or whatever, they could easily say, okay, well, you default on your contract. I'm going to sell it to this financier, this third party, whether it's a pension fund, whether it's an opportunistic hedge fund, or some sort of high net worth individual who just decides to buy 25 units. They could do that at a discount. And yes, it has to be fair, the whole liquidation process, or the whole foreclosure process, or the power sale process. That has to be fair, because otherwise you can, as a purchaser that defaulted, you can go sue them and say, hey, you just gave it to your buddy for $1. Like, that's not going to happen. But it has to be a fair process. Assuming they bought it at a fair process, whether it's a 5, 10, 20% discount, guess what? You're still on the hook for that because there's recourse. So they'll come after you. It might take months, it might take years, but they'll be able to sue you. And black and white in the court of law, they will win. So again, I'm not a lawyer. I'm not giving you legal advice. Talk to a lawyer, a litigation lawyer specifically, if you're in that situation and this applies to you. Or maybe there's some sort of leaseback arrangement that you can have with a developer where they will close in it for you and you lease it from them, or other way around. I don't know. There's got to be something creative. You just got to be in communication with them. So like when you're buying the condos, it made sense to go with a larger developer because they had enough financing or capital to weather the storms like a smaller developers wouldn't. Like you've heard in the news, especially at the start of this interest rate hikes, you saw a lot of these smaller developers go under. The larger ones were able to withhold and weather the storm. So I always recommended back then to go with a larger developer. But the problem is, if you bought from a larger developer, they hide behind their lawyers. Unless you have a direct contact with them, or you know them from the inside, or maybe I know them, or maybe I can talk to them, but they're going to talk to their lawyers. And you're probably talking to another firm that's large, and they just don't care because they're a third party. They're there to protect their client, which is the developer. And you're not going to get much negotiating with them. You can't play the heartstrings. You can't say it's negative cash flow. It's going to financially ruin me. They don't care. They want what you agreed to, and it is what it is. So in those situations, it's going to be really tough to negotiate with them. But if you are able to get with a decision maker, maybe there's some sort of solution you guys can come to. At the end of the day, it's a negotiation. You know what they want. They just want their money. They just want you to close on it. Yeah, I know what you want. You can't get the money. You want somebody to lend you the money. You can't figure out who to lend you the money. Banks don't care because they don't have to, unless it's RBC who might be invested into it and just seeing the whole overall process work so that they get their return back on the money that they lent to the developer. And they put the liability on you as the individual purchaser instead. I know it's a little bit tough, but you got to try your best to see what you can do. Okay, so let's say you can't find any financing-based solutions, you can't find any contract-based solutions, you can't find any kind of way to negotiate with the developer, or you just can't find a solution that works for everybody. Then you're at the, oh my God, I'm going to die kind of like solution where you're going to claim bankruptcy. It's really stressful. You can't sleep at night. I get the stress. That feels like pain. It's real financial stress. It'll drive some people insane and crazy and desperate. Let's talk about some of the solutions. What do you do? Well, you can basically negotiate an exit with the developer. I mean, I know that the contract-based solution is one thing, but this is where you actually can't close. You say maybe you forgive the deposit, or you just take your chances and get sued. Again, if you get sued, again, not legal advice, but if you get sued, it could take several months, years, or decades even to actually financially claim against a person with little or no assets. I've heard of some guy wanting to claim bankruptcy and move to the States. Like, that's extreme. For me, I wouldn't be able to do that. I have too much ties in Canada and Toronto, my family, friends, and just my roots are here. I just can't pick up and go like that. But some of you might be able to. Who knows? I'm not saying run from your obligations, but maybe this is just a strategy. So yeah, hopefully that's some ideas of what you can do. For the third time or 10th time, I'm not a lawyer. I cannot represent you. Don't take this video specific legal advice. The goal of this video is to give you some ideas that you can think outside the box, that the world is not about to end because you have this big financial obligation ahead of you. For some of you, it can destroy you, yes, but look, there's more to life than just money. And it's easy to say for somebody who has money. I'm not saying I have a lot of money, but there's people that have money and it's not the end of the world. What really matters is your health, the people around you, the people that love you, and your life itself. That matters more than money. Money can come and go at any time, and unfortunately this situation is probably going to go, but there's ways to mitigate it. If you want to talk, you know how to reach me. Stay tuned to this video. Subscribe to this channel if you want. I'm going to try my best to give you some honest, unfiltered advice. I have no skin in any of this. Thanks for watching.
Add it up.
Thanks for sticking out to the very end. I hope you got some value out of this. Do me a favor, please press like and subscribe, but more than anything, leave me some feedback so we know what to produce for you going forward. Thanks again.